Welcome. This is the lecture for Chapter 20, the Financial System Opportunities and Dangers. This textbook was written a few years ago. You can see it here, if I can get out of your way. You can see it here, copyright 2016. So this chapter tends to focus heavily on the Great Recession that started in 2008, 2009, and that we were really just still coming out of in 2016. The three main topics are what a financial system does when it's healthy, what can go wrong, and what we can do to prevent those problems. Now, what the financial system does. The financial system is a general term for the set of institutions in the economy that help allocate funds from savers to investors and to provide a means for households and firms to share risk. In earlier chapters, the financial system was modeled as a single market for loanable funds, where saving was channeled into investment projects. But in practice, the financial system is much more complicated than that. It includes a variety of mechanisms for savings and investment. One component is the financial markets, which enable households to directly invest their savings by buying securities. Another part of the financial system are financial intermediaries. These help households indirectly invest their savings. Simple example is a bank. Now, two important kinds of securities traded in financial markets are stocks and bonds. Bonds are securities that promise to pay the buyer a set amount of money at a particular point in the future. They're issued by corporations and by governments. Stocks are shares of ownership in corporations, which is why they're called shares. Unlike a bond, a share of stock pays a dividend, which is, very loosely speaking, a share of the profits. Raising investment funds by issuing bonds is known as debt financing, and raising funds by issuing stock is known as equity financing. Debt and equity are types of direct finance because the person buying the security knows roughly what investment their savings are going to finance. I should note that when someone buys a stock on a stock exchange, or a bond if you're buying it on the secondary market, no new investment funds are being raised. It's only a change in ownership of an existing investment. Now, in the case of financial intermediaries, a saver generally does not know what specific project their savings are financing, which is why they call it indirect financing. The financial system provides a mechanism for helping people share risk as well. Even if a person could finance an entire investment project themselves, well, you probably wouldn't want to do that. Because of the risk that the project might not pay off and you'd lose all of your savings. People usually prefer not to put all their eggs in one basket, so to speak. They're risk averse. People don't want to lose everything if one particular project fails. One way to deal with risk aversion is diversification. That's spreading your savings across many different investments. Using financial intermediaries is one way to diversify your investments. For example, mutual funds sell shares of the fund to savers and then use that money to buy stocks or bonds from many different companies. That reduces risk because it's unlikely that all of the companies will go under at the same time. But diversification has limits. It can eliminate most of the idiosyncratic risk associated with an individual business, but it can't reduce systematic risk. Systematic risk is the risk of something that would affect the whole economy and so would potentially have a negative effect on all of the business, no matter how many you invested in. Think a recession. Another problem that can happen in markets is asymmetric information. This is when the two sides of a transaction know different things. This can cause markets to malfunction. A classic example of this is in a 1970 paper by George Akerlof called The Market for Lemons, about how information asymmetry can, in some cases, cause a market to completely collapse. He uses as an example the market for used cars, some of which good used cars he calls peaches, and bad used cars he calls lemons, thus the market for lemons. Now, there are two basic kinds of information asymmetry based on whether the effect occurs before someone enters a market or after. If the information asymmetry causes a person to choose whether to enter a market or not, it's called adverse selection. A very common example is in insurance. Imagine that you know whether you are healthy or sick, but the health insurance company does not know. You might use that information to decide whether it is a good deal for you to buy health insurance. If you know you're sick, you might think buying health insurance is worth the price, the premiums. But if you know you're very healthy, you might decide it's not worth it and not buy the insurance. Adverse selection can trigger in a market what's called a death spiral. The way it works is, since in the health insurance case, only sick people would want to buy insurance, because if you know you're healthy, it's not a good deal. So the average cost of the people who are insured would be high. So the insurance company would have to charge high premiums to stay out of bankruptcy. But if the price of insurance goes up, then maybe people who are in an intermediate level of health decide it's overpriced. It's not a good deal for them. And so they might exit the market. Well, now the people still in the market are on average even sicker, meaning more expensive. So the insurance company, to stay in business, would have to raise premiums even more, which would drive more people, the relatively healthier people, out of the market. And the average cost of people still in the market goes up again, and the price of insurance would spiral upward. And the number of people participating in the market would keep falling, and the market eventually would collapse. The other main type of information asymmetry is called moral hazard. This is when the hidden information is relevant not in determining whether you want to enter the market, but rather to your behavior after you enter the market. To use the insurance example again, the knowledge that you are insured might make you take on more risk than you would otherwise, because you'd know that you won't pay all of the cost if something bad happens. Now, financial markets have developed systems to deal with information asymmetries. A couple of simple examples here. If banks couldn't tell who is a good risk for a loan and who's a bad risk, excuse me, then they would have to charge everyone more to borrow money. They would have to charge the rate for an average risk person. Now, this would be a bad deal for people who are a good credit risk. They know they're a good credit risk, but they're paying a rate for average credit risk. They know that's a bad deal, so they don't borrow. They exit the market. The average risk of borrowers then would go up, causing the price of borrowing to go up. More people who are good risks leave the market. This is adverse selection. Banks deal with this by requiring detailed information from the loan applicant in the loan application forms to try to detect who is a good risk and who's a bad risk. That way they can make loans to people who are a good risk at a low rate, and people who are high risk and charge them more. You probably have encountered this when you apply for a credit card. If you have a very good credit rating, you get a card with a lower interest rate. The financial system is also fundamental to economic growth. You can't have growth without savings and investment. And the financial system channels resources from savers to investors. Without a well-functioning financial market, it would be very difficult, essentially impossible, to finance investments in a large, complex economy. Now, that's what markets do when they are functioning correctly, but they don't always function correctly. Since this section of the textbook was written shortly after the Great Recession, it uses that as an example of what can go wrong. But it's important to understand that this same pattern and the same cycle of events has happened many times before that, and probably will happen many times again in the future. Financial crises are typically preceded by a period of financial optimism. Alan Greenspan referred to it as irrational exuberance. The Keynesians call it animal spirits. And this period of optimism leads to large increases in asset prices. In some cases, the price of an asset will rise above any rational estimate of the present discounted value of its future cash flow. So people start buying these assets simply in the hope that someone else will overpay for the asset even more than they did, and they can sell it as at a profit. This is a speculative asset bubble. Now, eventually prices rise so much that there isn't anyone willing to pay an even higher price. And when that becomes realized, people who have already purchased the asset figure out they've paid too much. And they all try to sell at the same time to get back some fraction of their investment. This is how price bubbles pop and asset prices crash. When that happens, you can have insolvencies at financial institutions. When asset prices fall, the value of assets held by financial institutions can fall below the value of the company's liabilities, which means the company's insolvent. A commercial bank can become insolvent due to loan defaults, triggering regulators to step in and force the bank to close. For other types of financial institutions, the value of their assets declining can cause their net worth to turn negative, also forcing them out of business. And financial institutions frequently owe debts to each other. They invest in each other. So insolvency can spread throughout the financial system. When one institution fails, if it's a large one, and defaults on debt payments to other financial institutions. When an institution is solvent but doesn't have enough liquid assets to make payments, it can be forced into failure anyway. If its creditors demand payment, go to court to force payment, triggering the institution to sell its assets, its illiquid assets, at fire sale prices. Prices below what they could get if they waited a little while. They're essentially selling assets at below their true value, in a sense. Now, government deposit insurance does help prevent this from happening, but not all deposits are insured. With insolvency rising in financial institutions, speculation will grow about which institutions will be the next to go under. So, people are worried and they pull their money out of uninsured deposits. This forces banks to cut lending and sell assets. Declining asset prices in turn affect other banks because they're required to revise their balance sheets to reflect the lower value of their assets. Now, financial institutions that don't take deposits, like hedge funds and investment banks, can also experience a liquidity crisis when they can't raise funds to pay off their maturing debts. They often borrow by taking out short-term loans, and when creditors lose confidence and these sources of funding dry up, the institution can be forced also into a fire sale of assets and can become insolvent. During the start of the Great Recession, the financial crisis, 2008 and 9, for example, the financial system faced tremendous uncertainty about how far insolvency would spread. Because the major financial firms had contracts with each other, there was significant concern that this interdependence could cause the entire system to collapse. This leads to a credit crunch. As asset prices fall, commercial banks become increasingly reluctant to lend because the value of borrowers' collateral has gone down with the decline in asset prices generally, and that makes lending more risky. When there's a credit crunch, firms and individuals who rely on borrowing are forced to reduce spending, and that can push the economy into recession. The decline in asset prices itself causes a drop in aggregate demand, in part through the fall in household wealth, which causes consumers to reduce spending, and it can also increase uncertainty, leading firms and consumers to reduce their spending. The recession that develops can cycle back to make the financial crisis even worse, because if expected profits are lower, then that's going to drive stock prices down. Reduced demand for real estate can cause real estate prices to drop, and a reduction in demand for loans due to the recession can worsen the financial condition of financial firms, leading to additional bank failures. High unemployment leads to increased defaults on loans, further weakening the financial system, and a vicious cycle can occur that causes the recession to become deeper. Now, this slide corresponds to a case study on pages 593 and 94 about each of the culprits in the beginning of the Great Recession. First, there's enough blame to go around. The Fed kept interest rates very low, after the 2001 recession, which contributed to a boom in debt-based real estate investment. Home buyers borrowed and spent more than they could really afford to on houses. Speculators purchased houses with borrowed funds, betting that prices would continue rising. And when housing prices began falling, many of these investors defaulted on their mortgage loans. Mortgage brokers would immediately sell the mortgage loans they made, so they didn't retain any risk, any default risk, and so had little incentive to verify the credit worthiness of the people they were lending money to, and to expand their business to people who might not otherwise be able to afford loans. They offered very complex loans with low down payments. Investment banks, they purchased these mortgages, and then they would bundle them together into what were called mortgage-backed securities, and then they would sell shares of these mortgage-backed securities to institutions like banks and pension funds. And the people buying these mortgage-backed securities frequently were not fully aware of how risky they were. In part, this is because of the rating agencies. Rating agencies rate the riskiness of investments. Now, prior to the financial crisis, they gave very high ratings to mortgage-backed securities that later turned out to be very risky. The textbook says the models these agencies used to evaluate the risks were based on dubious assumptions. Additionally, it's well known that rating agencies earned their income in part from the companies whose assets they were rating. This created a conflict of interest. Regulators, they didn't consider the possibility of a substantial decline in housing prices or the systematic problems it would cause to the financial system. A lot of people think that the failure of regulators to revise their rules to keep up with fast-paced financial innovations also contributed to the crisis. For example, lack of capital requirements for firms selling complex derivatives, such as credit default swaps. Basically, the finance industry was innovating very rapidly, and regulators didn't keep up. And government policymakers certainly share part of the blame. For years, decades, the federal government in particular, but state governments too, have encouraged home buying. The mortgage tax deduction is one way it was done. The establishment of government-sponsored enterprises like Fannie Mae and Freddie Mac to encourage mortgage lending. These policies led to increased borrowing and home buying, including by households that probably should have been renting rather than buying. The Community Investment Act also played a role. This was passed in 1977 to supposedly encourage banks to make loans in low-income neighborhoods. Under the CRA, banks were evaluated periodically by regulators to assess their compliance with efforts to, the phrase was, support the communities in which they operate. Their compliance, or lack thereof, was then used as a factor in regulators' decisions about whether to approve applications for new branches or to merge with other banks. Under the Community Reinvestment Act, banks were not subject to explicit lending quotas, not required to make a certain fraction of their loans to their local communities, and it technically did not require banks to make high-risk loans. Technically. But in practical terms, it operated differently. It functionally was used to impose lending quotas on banks, where they had to make some fraction of their loans to people with low incomes. This was a problem because it ignored the fact that there is a fairly strong correlation between someone having a low income and someone being a high credit risk. So, why was there a financial bubble? The previous bubble, the dot-com bubble, had burst in 2000. That pushed the economy into recession. Then, on September 11th of 2001, the terror attacks of 9/11 occurred, and they damaged the economy further. So the Federal Reserve, to combat the recession, pushed interest rates down to try to stimulate the economy and get us into economic recovery. That's where this quote that I showed you, I think last week, comes from. Part of the problem is that bubbles do stimulate the economy in the short run, but they also burst. So, what's the difference between a bubble and ordinary economic growth? That's where Austrian economic theory can shed some light. That comes next week. Hope to see you then.